Hey guys, we're putting in overtime this week. So me and Kevin Green once again doing a Sunday. With the markets moving fast and all these things happening recently, there's so much going on. It's always great to have Kevin on. Kevin hits me up last night. I was actually playing a basketball game. My nephew was in town, so we were playing pickup runs. I invited a bunch of people. A bunch of people showed up. It was great. So we're running these pickup runs. I'm dead. We're running ones and twos to 21. We played 3 games in a row. And like I'm about dead. Pick up the phone. Kevin's like, maybe tomorrow, and I'm like, yeah, fuck it, let's do it, man. So I was like, yeah, cool. So Kevin's like, all right, we're gonna get up tomorrow, do this. So now we're here. Wavy, you got the notification for once. Great job. But so now we're here. So much to talk about. Want to get into energy. We want to get into OPEC. We want to get into grains because those are seemingly bottoming out. You guys see my post the last couple of weeks about if you guys are subscribers on Against All Odds Research, you've seen the post of the cattle futures finally going down a little bit, making new 60-day lows. It might even be more than that at the moment. And then, the grain's starting to bottom out. We're starting to see some buy signals. Soybeans hit a new 52-week high. So we're going to get into that. So let's get into it, Kevin. So first off, this is new news that are just coming out. And, I just want to highlight this a little bit because this is not the most abnormal thing in the world, but it's like front page news right now. Everybody's talking about it. We're talking about reverse repo rates. So this is a Reuters article. Banks tap Fed standing repo rate in record numbers amid month-end pressures. I'm going to pass this to Kevin because, you guys have heard me talk about the Fed repo a lot lately, but Kevin has a really good sense of this stuff as well. So, Kevin, what do you see here? Is this something that people should be worried about? Is this something that's going to hit the markets? Are we going to have the Black Friday on Monday or Black Monday on this week? Is it going to happen on Friday? What's going to happen this week, Kevin? I know you have a crystal ball, so tell us.
No crystal ball here. I appreciate it, Jason. Yeah. Okay, so a couple of things that we have to be just mindful of. The reverse repo facility for the Fed, the functionality of that is, a bank may have some securities, some treasuries, some MBS securities that they give to the Fed overnight. And then the Fed basically lends them cash, and that cash usually goes on the bank's balance sheet. And we did have, obviously, month end on Friday for October, and this is not out of the ordinary. Now, we have seen the reverse repo market kind of be a little bit stagnant over the last, let's say, 5 months, 6 months or so. So anytime that we see any type of blip of activity, especially when it happens on a Friday, it usually does, give a little bit of headlines for those that do weekend market updates and things of that nature. But I would say if you look towards this time next week, or if you look at Friday of next week, it probably should kind of fix itself for the most part, or you'll probably see activity kind of going down. This is most likely just banks trying to mark their books when it comes to their balance sheet just for the month end, just in general. And you see a lot of activity and interesting stuff that happens on the last trading day of every month. I mean, if you kind of go back, look at your charts, last trading day of every month, we usually see a lot of volatility. Market usually starts off fairly strong, gets a little bit weak, which is exactly what happened with the S&P 500 on Friday. And then going into the close, that's when you have a lot of institutions rebalancing their portfolios, selling certain assets, buying new assets and things of that nature. That's when you see the market kind of push to the upside. And that's exactly what we saw. And then, we also have the options flow that's also kind of impacting some of that velocity to the upside on an intraday basis. And then what happened 5 minutes, 10 minutes going into the close, we dropped 25, almost 30 points, right? Like that's just usually what we see. But I wouldn't get too concerned about the reverse repo market just quite yet. Once again, I think this is just a markup. We've seen the same situation, I want to say back in June, if I'm not mistaken, where we saw this huge spike for 2 days of the utilization of the reverse repo market. Nothing really came of that. I believe it also happened in April. Nothing really came of that as well. So it's a headline mover for now. But those markets, obviously, on a day-by-day basis will change. And what really kind of occurred here, we obviously had the Fed cutting rates this week. Jerome Powell kind of put a little bit of cold water on December, having a rate cut at this point in time. He's going to follow the data, the uncertainty, and if the lack of data, he's kind of looking at it and saying, the lack of data that we have, it's harder for us to cut. I would say that's a little bit of a surprise. Usually it's the opposite way. The lack of data that you have, your concern is that something is crumbling and you're not able to see it. So you do cut rates. Obviously, Jerome Powell kind of had a different message. You did see obviously markets backing out of those probabilities. And another reason why you probably started seeing a little bit of activity in the reverse repo market, a lot of these, I want to say secondary markets, if you will, but a lot of their rates were kind of just disconnected from Fed funds. So you try to find also opportunities where what's paying the highest yield, what's paying the best yield right now for your capital and your cash. In the reverse repo market, I believe if you're kind of looking at that day rate, was actually pricing in a little bit higher than what you would see for overnight lending between peers, right? So banks will do that as well. It just kind of depends on what the rate is doing. That'll all kind of figure itself out. I would not get too concerned about it. Is it a sign of lack of liquidity in the market and does it create volatility? It does, but it's usually very short-lived. And when I say very short-lived, 1 day, maybe 2 days, and then everybody forgets about it and we kind of move forward.
Yeah, so the one question came up, which is, they were wondering about the amount. Is the amount concerning? The numbers. There've been a couple numbers thrown around: 29 billion, 50 billion. Do you think these numbers are concerning, or do you think it's just more like to just what you said, like just a little bit of volatility, possible and possibly not, and just possibly move forward on it in the next couple days?
Is the velocity a little concerning? So it was 51.8 billion. Is it concerning? No. And actually, Jason, I'm going to send you a DM here. We can actually pull up a chart on the Fred website, and we could actually look at this together, so people can actually have a little bit more.
Just send me the link what you're looking for. I'll bring it up on my browser.
Yeah, I'll send it to you over right now. Is the velocity a little concerning? No, I wouldn't get too concerned about it. And here's the reason why. If you kind of look at where the reverse repo market has been as far as utilization rates in the past, it's been a lot higher. So I just sent you the link and a DM on X here. We did see a little bit of a spike. The last time we did see a spike of this magnitude, let's say it was September 30th. And what's September 30th? Last day of the month, right? You usually see kind of these fluctuations. Now, you would get a little bit concerning if we start breaching, let's say, $200 billion, $250 billion in this reverse repo market. Then you got to ask yourself, well, why is that the case? Right now, the banks utilize reverse repo to get cash and get capital, right? And so they put up and pledge securities in order to get cash to mark their balance sheet. Nothing more, nothing less at this point. They also have other windows from the Fed in order to obtain capital as well. That's something that's just not really being utilized at this moment. So I wouldn't be concerned about it. So you can look at this. I'm not sure what that time frame is. Probably what, 20 years, 5 years? 5-year time frame. Yep. So Jason, if you can go back to that chart and then to the top, if you can click on 1 year, and then I think that gives us also a little bit. So are we concerned? This is just happening over the last 1 year. Mm-hmm. So is this a concern? I mean, back in July, we saw a spike. Once again, month end. Back in April, we saw a spike. So at the end of the day, and actually that was a quarterly, but at the end of the day, are we seeing massive utilization rates that's going to be sustainable? Right now, I would say that's probably not the case. It hasn't been the trend, but this is kind of what you're looking at. So we're on the right side of that chart there, and we have an article about it, and everybody's talking about it. It's not a huge blowout. You see a sustained, utilization of around 200 billion, 250 billion, and it sustains itself for a month or so. Yeah, and then you start asking questions, what's going on with the liquidity of a lot of these financial institutions right now? I think this is just par for the course.
Yeah, I agree, Kevin. I think it's something that a lot of people are going to, I mean, this is what we do here and what we do well, which is like dissect these things that everybody's getting hyped about. Everybody has a lot of feelings about, especially like if you go on, Twitter or TikTok or YouTube, you're seeing people act like it's the end of the world. The financial markets are ending. Monday's going to be terrible. It's going to be another Black Monday. And like what we're telling you guys is like, this isn't something that's extremely concerning by any means just yet. If this continues and just continues to get out of hand, maybe we'll come back and talk about it.
Yeah.
But I think it's just a headline mover at the moment. And speaking of which, we got a lot better stuff to be talking about today. Do you guys want to talk about energy? Like I know I do. Do you guys want to talk about the grain markets? I do. There's so much going on in the commodities market at the moment and how it's going to affect equities going forward. So we're going to hop into that. Let me pull back up the other screen. get back to Kevin's charts because Kevin brought some great charts today. All right, show, here we go. So pulling it up, got crude oil here.
Yeah. All right, so from the crude oil front, obviously we continue to see lower highs, lower lows. We did see a bounce in prices to start off the week. Last week on the Sunday overnight session, we hit and crossed that $62 level. I posted this on X. You know, it wasn't like a huge call or anything of that nature. It was just an observation. Look, we were hitting the 50-day moving average on crude. Now that's the 50-day moving average. We're looking at a weekly chart, but it was a 50-day moving average that we were actually hitting, and we did see some sellers kind of step in here. The fact that we saw some news reports that the Russian sanctions may not be as aggressive kind of backed off this market as well. And then you also have this fear of this OPEC plus meeting that is taking place today. Actually, I believe right now there is a market is expecting 137,000 barrels per day increase from OPEC plus. That's similar to what we saw for last month. Once again, this is more symbolic in nature. 137,000 barrels is not going to make or break the oil market right now, but it is more symbolic. I think there's a couple of things to be mindful of when you're looking at OPEC plus's increases. One, it's to keep mainly two countries in line that have been overproducing for a very long time. And then two, I do believe that they're trying to recapture some of the market share that they have lost because of shale here in the United States, as well as potentially in South America. If we want to veer down some crazy road, we can do that a little bit later when it comes to the Venezuela situation here. But at least for right now, 137,000 barrels looks like that's going to be on the radar. I wrote about that yesterday. It was published yesterday, actually. And there is a delegate that is coming out and saying that that's going to be the case. What is also going to be very interesting in today's open, though, Jason, we actually might see a little bit of a bounce in crude oil. I'm not sure how aggressive it's going to be. But this delegate is basically saying that 137,000 barrel increase production quota, and this is very important. I'm going all over the place, but this is very important. When we say increase, we mean the quota is increasing. It doesn't mean that actual physical production is going to meet those levels. It just gives them a little bit more wiggle room, if you will, right? It's just kind of like a credit limit. You say, hey, you have a $10,000 credit limit on a credit card. You can spend up to $10,000. You could spend up to $10,000. Are you going to utilize that or not? Right? I mean, they're two different things. But this delegate is also saying that in January, they probably will pause these production quota increases as well. That actually could be a little bit of a tailwind for the oil markets, as well as the byproduct type of markets as well, if you're looking at diesel or gasoline. So it's trying to bottom. It is trying to move higher here, but the trend is still confirming to the downside for now. And then last but not least, winter months are usually bearish because of the seasonality effect. You have lower consumption from the consumer standpoint, right? We consume less gasoline generally, transportation of goods. So the consumption of diesel usually also levels off in some respects. There's a small little heating oil market, which is basically diesel, that will have an uptick because it's utilized for heating. But overall, usually you do see a little bit of a consolidation within the winter months when it comes to the oil patch just in general. I think if you're looking at Venezuela, let's say the news reports are true and the U.S. is going to strike some military assets there, it's probably as far as that it's going to go. So Venezuela generates and produces around 1 million barrels per day of oil. You know, we can say all we want about Venezuela, and we could say that they're a narco state and terrorists, this, that, and the other. We're still importing from them, right? I mean, Chevron does have an operation there. Last week, I'll get you guys the numbers here. Last week, we imported 121,000 barrels per day from Venezuela. The week before, 302,000 barrels per day. The week before, 49,000 barrels per day. And then the week before in October, 194,000 barrels per day. We're averaging around 166,000 barrels per day of oil that we are importing from Venezuela. So we do have a vested interest there. We do have assets that are there. And so is there a risk that we would hit our own assets when it comes to oil? Probably not. Right. And so I think if we do see initial strikes, and this is all speculation, but if we do see initial strikes, we could see a bounce to the upside just because of the algos. But if you think about the long-term trajectory and military objectives, as well as the interest of the United States, it's highly unlikely, it could happen, highly unlikely that we would actually strike oil-producing assets that are there because we would be hurting our own people, our own interests. And then last but not least, and this is something that people don't recognize here, Venezuela is that's the number 4 importer of crude for us. Is Venezuela, actually, right? So we have obviously Canadian crude is going to be the number 1. That's like the bulk of what we get, especially the heavy. We get Mexico crude, we get Saudi Arabia, and then boom, Venezuela. So there's politics and then there's reality. And I think that I just wanted to kind of highlight what the politics are right now, where you are seeing in the headlines. And then there's also the reality. So I would say if you're kind of banking on crude oil going to $80 because of Venezuela, we hit Venezuelan assets, I would say you're going to need to have another catalyst that's going to be able to sustain those prices. This won't be the jump off point for crude moving aggressively higher, in my opinion. What are your thoughts around crude oil and kind of the setup here from a supply as well as a technical standpoint, Jason?
Long term, I'm bullish long term. But in the short term, I think exactly like you, it's like people are looking for this to happen immediately. They're looking for this perfect bottom, and then next thing you know, it's just going to turn around, and we just don't have the setup fundamentally, technically. Look at this chart. I mean, we're hanging around the bottom. Like maybe we take a little run, maybe we make it back up to 70. That would make some sense, sure. But really, if it's news driven, and this is something I talk about all the time, news driven breakouts are the worst breakouts. Think back to, even go back here. We could go right here on Kevin's chart. You see this massive, it was a false breakdown signal. And once again, like, it's a signal. You could take the trade, but this big move here, that was all news driven. News driven breakouts are the worst breakouts. If you talk, go all the way back to Market Wizards from the 80s. Bruce Kovner talks about this. You guys have heard me talk about this a million times, but I'm going to give it to you again, which is Bruce Kovner talks about when you have a breakout happen and nobody knows why. That's usually when something happens and why in like 6 months or a year, and it usually continues in trends. Think to gold in 2024. You get that breakout that happens in 2024. It really doesn't look back. Everybody's saying it's a bubble by the time it hit 2,500. And then it just kind of continues. Now we're at 4,000. Oil, we're just seeing all these news-driven catalysts, and we're not really seeing a structural catalyst yet. I do think towards the end of the year, we might see something change with that. Like Kevin said, the short-term seasonality isn't great. Look at November, December, just look at a seasonality chart, make it simple. It doesn't look great. But once we get into January, February, we start to see that change a little bit. And that's where, if anything was going to happen, I would expect some sort of reversal there and it to prove itself to me. But once again, it's a couple things. One is, if you pay attention to the seasonality, something to think about, which is, this is how I pay attention to seasonality, at least, which is, if I look at, oil and I say, okay, oil's probably going to be in a bad seasonal period right now. And let's say oil starts to strengthen right now and it starts to actually prove me wrong, prove Kevin wrong, and it continues up. And that's going to be something that I would say, okay, that's a very bullish sign for oil. And the more nobody knows exactly why, the better off it probably is going to be. But at the moment, it's short term, and Kevin's talking in that sense, and I'm talking in that sense at the moment too. Short term, I'm not the biggest bull on it. Long term, towards year end in the next year, I'm getting a little bit more bullish. But once again, it still has to prove itself. The thing I've been talking about on here for months, which is oil above 80. If we're just looking at price action, making it very simple, oil above 80, XLE above 101. I'm going to be more bullish on these sectors until that point. And the one thing I want to pass off you, Kevin, a little bit, if we're looking at this cycle, and if you go all the way back and look at every oil cycle, every time oil's made a big move, we basically see gold, silver starts to move. Then we start to see the rest of the commodities complex start to pick up a little bit. Lithium miners are moving, uranium miners are moving. We've got copper stocks, we've got metals and mining, we've got steel stocks, we've got aluminum stocks. All these things are starting to move in a big way right now. So my thought on it is the fact that I think that it would be very surprising to see energy not join the party at some point. I don't think that party's happening today or tomorrow, but I think it's going to happen at some point. So I want to know your thoughts on that. Do you think that all these sectors moving has anything to do with oil? Or do you think that this is just a situation where, things have changed so much now, and maybe there's so much supply of oil that these sectors are going to move first and continue to trend, and then we have something like oil, which is just going to be left behind for a little while?
Yeah, I think a lot of those different commodity markets, they have their own separate thing. Now, I think that if you kind of look at the longer term trend, if you're talking about yearly trends and something that you're swing trading for, let's say 3 years, 4 years, could you make the case that, yeah, could oil kind of re-rate higher and kind of lead us into this a commodity cycle, if you will, for others? I think that's possible. But I think right now, a lot of these commodities are trading off their own themes. And I don't think crude is really kind of giving us any type of signal one way or another. Here's the reason why I say that. Right. Crude's still below $65 if you're looking at WTI. That's obviously still a big warning signal for me. I mean, you and I have been doing this for what, a year or 2 years or not now. So I mean, it's below $65.
Covering all the chop and oil for a long time.
Yeah. Below 65 is still a concerning economic indicator signal for me. So I think that's one. Two, you do see OPEC once again kind of increasing their output, their production quotas, if you will. Anytime that we do see any type of meaningful bounce, I think they also were increasing their output per production quotas. And I'm speculating here, but it probably is. There's some merit to this. They probably also did see the writing on the wall when it came to several different geopolitical risk events. I mean, the Iran strikes that we had, if you kind of notice, we started seeing them ramp up their production quotas right before that actually happened. Because in the event that we do see assets in Iran getting striked, they're gonna have to obviously meet any type of supply deficits. Same thing that happened with obviously Israel and those moves to the upside as well. So I think they actually can see certain things on the horizon, and then they're trying to preempt some of those situations. Even the Russia sanctions, on paper it sounds like it's going to have a bite. In practice, I think that it's going to have to prove itself. Sanctions really haven't been that effective. And in any commodity, if you will, right? Any commodity is going to make it to the market one way, shape, or form. It just depends on how. So if they're saying, hey, you can't import from Russia, you got to find somewhere else, where's that oil going to go? Because it's not just going to sit in Russia. It's just not how it happens, right? And so I think you also have kind of OPEC being a little bit more preemptive in the event that we do see geopolitical risk events kind of escalate here. And I think that's actually kind of bearish. And then from a demand side standpoint, it doesn't look that great for the consumer right now. Look, the market, everybody's kind of focusing on the equity market. Look, we have this massive move to the upside. AI boom, that's great and all, but when you're kind of looking at the consumer, let's talk about 70% of the consumer, 75% of the consumer base here in the United States probably isn't doing that great. And you can look at consumer credit metrics from the Fed around that, consumer sentiment data on both sides of the aisle, not just one or the other, both of them. You can kind of see where the trend is going right now. And that doesn't really give a lot of favorability for the oil trade just in general, at least for now. Now, could you see a situation where first half of 2026, Europe kind of, starts to ramp back up here a tad bit? China markets start to do a little bit better because we have some stability when it comes to trade talks. Do we have any type of fiscal stimulus here in the United States? That sounds crazy. I know people are going to be like, what is that? What the hell is he talking about? But the longer and longer the shutdown happens here, the more likely that the federal government itself is going to have to provide some stimulative measures in order to stave off any type of economic slowdowns. It's going to be reflected in the data once we get the data back up and running, right? Once you have that environment, yeah, you can see kind of crude moving higher. But right now, this is all supply side driven. Every single one of these, for the last year, you and I have been talking about this market. And every time we get a glimpse of hope, it's not because demand is strong.
Yep.
It's because supply markets might be at risk of being reduced in one way, shape, or form. And that's really not conducive for prices remaining higher or elevated or a cycle. Now, because you asked me this, does this kind of show you what other markets are going to do? And right now I say no. If you look at copper, so the copper miners have reported over the last 2 weeks. It hasn't, look, their production levels for 2026 output for copper ore, every single one of the majors, the Glencores of the world, Freeport-McMoRans of the world, you name it, have reduced their 2026 output. And it's not because of lack of demand. It's because these mines are like getting destroyed and disrupted, unfortunately. And it takes a long time to get those mines back up and running. So there's a fundamental catalyst for copper because the ore itself is going to be in short supply. And it doesn't look like that supply is going to really come back online in a meaningful way until maybe Maybe the second half of 2026. I think that's a little bit more optimistic. You're looking at the start of 2027 for that to happen. So that's where you're seeing that re-rating higher. Uranium and uranium stocks, we had this whole critical minerals thing that's taking place right now. There's only a couple of uranium, publicly traded uranium companies that have exposure here in the United States. That's a concentrated market. You're seeing just dollars getting put to work because we have this whole situation where the U.S. government's buying equity or getting equity, either buying it or they're just getting gifted equity for whatever reason into those markets. So that's a separate type of cycle here that's kind of taking place, and other metals as well. So I think every single commodity has its own story. I mean, grain markets don't look that great outside of maybe soybeans attempting to break out of a 1 year consolidation range here, but you're not really seeing like wheat markets, which actually probably has the biggest amount of short interest in that market. You're not seeing them really rip to the upside yet because the supply in that market is still relatively high. Corn markets as well, maybe a little bit of a blip, but the supply there is actually relatively high, and we're getting outpriced by South America. And that's not something that we like, oh, they're taking our sale. We just can't compete. Our dollar's too strong, and South America has been able to ramp up fairly aggressively, especially when you're looking at Brazil and their production outputs over the last couple of years. It's exponentially growing compared to the United States. So they have more supplies, they have cheaper currency. It makes sense for China and other countries to buy from them. And so this trade deal is going to readjust that, but that's just kind of giving another example of grain markets. They have their own separate theme that's going on right now that's bigger than just the signal for oil. I just feel like these cycles are a little bit different and nuanced this time around, Jason. That's basically what I'm trying to tell you, right? I think they're a little bit different right now than what we have seen in the past. And I think people trading them have viewed these situations as a little bit more different now as well. Over the next 10 years, could we still see that cycle move like you're kind of talking about? Yes. Right. But if we're talking about the here and now over the next 6 months or 8 months, it seems like they're trading on their own style. They're trading on their own fundamentals rather than a rising tide lifts all boats in the commodity complex as a whole.
Awesome. No, I love that. I love that. And Nick said, how dare you guys use both sides? And it's like, yeah, like that's the thing I think Kevin and I do very well, which is understand like one, we're both gonna have points and no trader. And really, if you're sitting here and watching people like just agree with each other, like that's ridiculous. There's no traders who should be agreeing with each other. Everybody has different time frames, everybody has different trading styles, and everybody's using different products. If you're trading short-term options, you're going to have a different opinion of things than someone like me trading very long-term futures contracts. But also, looking at that, I do think there's one thing to be said, which is the things, even though commodity markets, yes, there's supply and demand, but really they're heavily in demand markets. Like if you see big demand in something like gold goes up, there's no reason for the supply side of it really doesn't matter. So we really kind of look at all of these different markets in a different context sometimes, at least for myself. But I do think that we're going to possibly see that move that direction, mainly because if we look at the, like, let's say copper situation, a lot of mines offline at the moment, makes sense. But, if we look at gold, we look at silver, we look at a lot of these other mines, like we're going to still need to create energy to get these things out of the ground. So we're going to need oil at some point for these things. I don't know when that demand picks up. Also, what's interesting about oil and something that you probably even know more than me about, which is if we look at people traveling anymore, people visiting new cities, people driving, these things don't happen like they did pre-2020. So 2020, if we look at oil, like obviously there was a massive undersupply. There's all these issues that kind of led to oil making a huge move. But if we look at today, it's like since 2020, people just, 2020 made a couple things happen. One is everybody's like, oh, Amazon, great. I'm going to sit at home and order my stuff. And that's the way I have to do it because legally you had to at the time. You can go to Walmart, but who wants to go to Walmart? So I'll just order groceries straight to my house. There's this thing called Instacart now. And then you just continue down the line. Then you got Uber Eats, then you got, DoorDash, and all these things continued to come out around those points. And so it kind of seems like, now people don't go to restaurants as much. So you see a lot of restaurants closing down in whatever town you're in. I'm in Columbus. The town is always booming economically. So it's always doing well. However, people are not going out to eat as much anymore. People are not going on trips as much anymore. People don't, really want to leave their house nearly as much anymore because they really don't have to. the people who are driving are the people transporting the goods for the most part, or Uber drivers or Instacart drivers and so on. So it kind of makes an interesting scenario here, which is, is oil in a scenario, and this is something that I've been kind of thinking about, is oil in a scenario where things have just changed so much that the demand that we would need to see for this thing to really start to move again isn't quite there just yet. And these things are kind of in the way of it and creating a point where we're not going to see that catalyst like we used to demand wise for something like oil. Just something I've been thinking about, but I'm wondering your thoughts on that.
Yeah, and that's the big question that you have. Is it because consumers don't want to, or can they not afford to do
Great point.
those activities? And that's the big question. No one knows. It just kind of depends on who you talk to, but no one really knows. We know that there is a cohort of consumers that are literally underwater when it comes to debt utilization rates. We know that we are starting to see layoff announcements taking place here. And those are kind of like anecdotal. We don't have the physical evidence when it comes to the government data, but you could say that usually towards the end of the year, there's a lot of companies that do shed workers, right? I mean, that's just usually what happens. The financial sector, wait until December. Wait until December. December is usually notorious for a lot of these financial companies to announce pretty decent layoffs. And then what happens in April? They report earnings, and then in April, they start to ramp up hiring again. Could it be different this time around because of artificial intelligence? Who knows? So that's the other point. Is it because people can't, or they just don't want to do those things? And, I would say that the crude oil goes through these cycles just like the economy goes through cycles as well. I mean, every single type of new thing that comes to the market, internet, for example, everybody looks at it and say, well, no one's going to have to move, right? No one's going to have to do anything because we have this new technology. And eventually the consumption is going to take place there. I just don't feel like we're there yet. I feel like we're at a little bit more of a slowing point for the consumer, not for AI, maybe not even for the equity markets, but for the consumer itself. And artificial intelligence will actually kind of build some of this demand when it comes to crude oil and just some of those byproducts as well. Natural gas is going to probably be another beneficiary of that. Building out these data centers obviously takes a lot of energy in order to do so. You need to supply energy for the power of these data centers as well. I can give you a bull case, but right now, crude from a demand standpoint just doesn't look that great. It's all supply side driven. And now you can actually have these cycles, and we do have these power cycles where you can have both of those actually align at the same time. And that's where you see these aggressive moves to the upside, right? You have the geopolitical risk event that takes place, Russia-Ukraine conflict. As soon as that actually happened, what also was happening at the same time? Fiscal stimulus, monetary policy from the Fed just starting to take hold within the economy itself. You started seeing a massive rip to the upside when it came to equities, also prices and inflation, and obviously crude oil was a part of that inflation, right? And so those are like those cycles that it's really hard to kind of short crude, but we don't have that right now. Last thing I want to say from just real quick, Nick was saying about the bias. Look, there's data to support that. If you look at the University of Michigan's consumer sentiment data, you go on their website, they actually have a breakdown between political parties, and then they look at current conditions, they look at future optimism and what the environment is right now. And everybody's been poo-pooing on this data set because it is bifurcated when it comes to the political affiliations, right? Democrats started off with President Trump, and they were just kind of dragging that whole overall index down. And you saw Republicans thinking very highly of the current administration and the direction of the economy. But what's actually interesting, if you look at that data set right now, you're actually seeing them both converge. And what I mean by that, conservative sentiment right now for the economy, current conditions, inflation expectations, as well as future conditions is actually moving lower. And for Democrats, it's actually moving higher. Right. So you can actually see that convergence. So we're not trying to we have this both sides, and I appreciate the compliment, but we're also going to back that up with the data to say, look, you're actually having a convergence, which is great. You want to see both of these kind of come into the middle here, and that makes it a better data set for sentiment overall, instead of having this exponentially differing views on what's happening with the economy. So that's just data straight up. That we got here. So I wanted to kind of talk about that as well, because we can talk all we want, but we're always going to try to have that data to kind of back it up and say, hey, it's a both sides situation right now.
Yeah.
And you're seeing it.
And Kevin could come on in 2 weeks and we could be, you know, in a completely different place. I could be completely bearish on oil and Kevin could be bullish. Like this is how it goes. And that's important because one, it's for me, like what I get the most out of these things and why I do these so much is because I get a lot out of it. Just the understanding, like what Kevin's viewpoint is. Like he's a trader I respect. I understand what he's saying. Like he explains things very well, which is why I bring them all to you guys. But I also get a lot out of it because you know I might have a viewpoint and I might go, hey, maybe I'm a little bit more too short term on this, and you know Kevin might think the same of me at certain points, so we just kind of go back and forth on this. But one thing I kind of wanted to talk about, Kevin, you know, my one thought actually, which is kind of creating a more bullish case for, and I want to talk about inflation a little bit more. If we look at inflation, we talk about the Fed. They've cut rates twice now. They ended quantitative tightening. So basically they're done with their balance sheet runoff. They're going to just stop that here. Could possibly move to quantitative easing at some point. I don't think they're anywhere near that at the moment, but that's something that people have been talking about. So, you know, I want to just kind of move into inflation. You know, I think that something's coming down the pipe. And for me, my thoughts are that, you know, one of these cuts are going to do it. It's not that it's going to happen immediately. So many people think like this is like a magic trick where the Fed like cuts rates and all the money comes in the system the next day and everything's fine. And it's really, no, it takes time for that to happen. You know, think about it as in, you know, maybe a couple months and so on. And this is why like everybody gets so bullish. But really, like, think about it this way. If Powell came in today and he cut rates to 0, you know, the market would rally like crazy. But did anything structurally happen to the system to make that happen? No, nothing structurally happened, you know. So once again, we're going to have to wait for that to happen. But I'm looking at this, Kevin, and I kind of see that any way we look at it, even though, you know, oil is struggling. I'm not saying to buy it right now. You guys know my levels. I've said it a million times. But oil's struggling. You know, some of these the inflation numbers aren't like, you know, looking too hot right now. They're starting to move up a little bit, but nothing crazy. Rents are moving down. Housing is moving down just a little bit at the moment, which is actually nice for some people. So, you know, looking at that, do you think that the Fed, if they continue to just cut rates, you know, Powell said it a million times. I think he was a genius for saying it. And, you know, he also almost got fired for saying it. And somebody did get fired for saying it, which is the fact that if we continue to cut rates, we're going to be in a scenario where, you know, inflation's coming back. And I still think that that's the right way of looking at it. But I do think, you know, once again, he's saying I'm data dependent, you know, December, blah, blah, blah. It might happen. It might not. I think they're probably going to continue down that path. Do you think that these rate cuts are going to lead to more inflation at some point? And also, I want to ask your opinion on this too. Do you think that Powell is going to continue to cut? I think like you said, you know, he keeps talking very hawkish. You know, he gets on TV and he's like, yeah, I don't know, you know, we don't have the data and all this stuff. But really at the end of the day, I think the Fed's gotten pretty political this year, and just I think they're going to continue down that path at the moment. That's my own opinion, but I'm wondering yours. You know, what do you think about the Fed here? Do you think that inflation's probably going to come back if they continue to cut rates, or do you think that there's something structurally in the system that they need to cut rates for at the moment?
Yeah, that's a really good question. I just want to go back to the crude. I mean, you treat this as, I mean, right now, from a technical standpoint, you treat it as a double bottom, and then you're looking at resistance of around 69.50. So I just want to be kind of mindful of that. From the Fed standpoint, I think Jerome Powell is really trying to continue to have that rhetoric, or I wouldn't say it's continuing, but he's providing enough hawkish rhetoric to try to bring expectations a little bit lower, because bringing those expectations a little bit lower also then tightens credit availability in a sense. It's not going to over tighten it, but it's trying to keep everybody in check, not to get ahead of itself. Because if he doesn't, he kind of opens up those floodgates, then yes, you have the situation where the market then gets a little bit too excited. They start lending credit a little bit more, right, which is going to be fueling the economy. But at the end of the day, does it kind of go overboard, and does the Fed need to then pivot, let's say next year or so? That could also create a little bit of a crisis, or the illusion of a crisis. So I think he's doing as much as he possibly can to keep the market just in check in general. And he is right. We just don't have the economic data. Now, I want to say something that's very controversial here. Inflation has been going up since May. Yeah. And I don't understand why people all the time over the last month and a half or so continue to say inflation's moving in the right direction, because it's not.
Well,
That
that's what
last
the Fed
CPI
continues
print,
to say. You know, it's the Fed continues to say that the
yeah,
inflation is
which is
moving in the right
incorrect.
direction, and like
It's
anybody who's
incorrect.
looking at the market, you know, anybody who's looking at the numbers is going, that's not right. But however, I'm sorry for cutting you off, but yeah,
Oh,
I'm seeing the
no.
same thing.
Well, even the people that are in the market, I mean, we had that CPI print. Obviously, it was kind of a nuanced one because they were doing the cost of living adjustments for Social Security. So they had to produce that one. And look, you could find bright spots within that data set, especially if you're looking at OER, owner's equivalent rent. If you're looking at that space, can we keep it at 0.2%? You would hope so. But let me tell you, over the last 2.5 to 3 years, we have seen 0.2% prints when it comes to shelter. And then we have seen them re-rate higher. The trend right now does not confirm that we're going to see it lower. In fact, if you go to shelter, this is exactly what has happened. In July, shelter 0.2%, August 0.4%. In June, we had shelter at 0.2% month over month. In May, 0.3%. Back in March, 0.2%. It doesn't mean that we're getting in that right direction, right? A trend means that you have actually three data points at least is to make a trend, right? 2 points to make a line, 3 to make a trend, right? And we don't have 3 points yet that says shelter is meaningfully coming down a little bit lower. Now, it was a nice print, and we have to be mindful of it because shelter's 40% of headline inflation, right? 35 to 40%. So it's a big deal. So you can actually have inflation in other areas, food at home, food away from home. Food at home is actual goods. Food away from home is the services provided when you go to a restaurant. Food away from home is more of a services indicator than a goods indicator. I think people don't really understand that as well. But we're not going in the right direction when it comes to inflation. The balance is, where's the labor market going? Because if the Fed had to choose, they were going to choose stabilizing labor market over trying to combat inflation any day of the week. You would do the same if you were a Fed chair. I would do the same as well. It's easier to maintain or try to battle inflation when wages are also moving to the upside in that same type of inflationary regime than it is to try to get the labor market picking back up. Now, the big risk that you have for next year is that you have inflation remaining sticky, you have job losses taking place, and then you have wages falling off a cliff. That's where you get a little bit concerned. That's stagflation for the most part. Stagflation also then coincides with GDP moving lower. I think that's going to be a little bit of a difficult task for us over the next year, 2 years, 3 years because of the AI boom. AI itself, these data centers are such a big chunk of our GDP right now. And so you kind of look at the headline number, you say, hey, the economy is doing great. And it's like 40% of that greatness is something that's being controlled by 1% of companies in the United States. Right. So you can't really rely on that. I think the inflationary picture right now, if we are going to go towards this stagnating type of consumer, I think the inflationary picture right now stays actually and remains a little bit sticky. I think the Fed actually has implied that they have moved their target from 2% and moved that target up to, let's say, 2.7% or even 3%. They're fine with that. And that does need to probably be the policy once we get this thing under control, where you have a floating rate policy based on wage growth and not just on a nominal 2% basis, because then that would kind of make a little bit of sense. You got inflation, let's say at 4%. Let's say you have wages growing at, let's say 3.5%, 4%, 5%, or what have you. If that were to happen, this is just an example. You could probably make the case, okay, yes, prices are going higher, but wages are moving higher. We just don't have that right now. Energy prices usually more of a deflator in the winter months outside of electricity and utility gas piped. Very volatile, but only about like what 4.5%, 5% of CPI. That inflation print also, keep your eye out on apparel. That increased by 0.7%. That's tariff impact right there. I'm pretty sure you could probably infer that that's coming from the tariffs load. And then you have food away from home, 0.3%. Once again, a little bit.
Wait, Kevin, so we don't produce a bunch of clothing here? That's very strange. I thought we produced so much clothing here.
Yeah, no, we don't. But what I'm really trying to say is what's going to happen next. And here's the thing. Is the Fed okay with inflation where it's at right now? I think enough members right now are okay with it. And you have to be mindful. The membership is going to change and sentiment is going to change once Powell is out regardless.
Mm-hmm.
right? Which the market's already pricing that in. That it's going to be a little bit more favorable for rate cuts. Now, is that the best policy? Who knows? I can't comment on yay or nay, but it seems like that might be the direction that we are heading towards. The ending of QT, I think it's very long overdue. That's your first signal that they are willing to backstop the economy and provide QE. That's your Fed put that we now have greater clarity on. And I think you probably do see a little bit more of a favorable Fed that also leads to maybe stickier inflation and trying to run this market hot. The housing market is under pressure, though. Definitely under pressure, and you're starting to see those cracks starting to emerge. Now, are buyers getting off the sidelines? You are seeing some activity in the mortgage application data that says yes, but we are also seeing in the mortgage applications this massive increase in refinance activity. You're talking about 111% year over year refinancing activity at these rates, which, yeah, rates have gone down, but they're not like super attractive. 6%, 6.3% isn't really attractive. So why is that taking place? Why are you taking equity out of your home? Are you utilizing that cash because you need to use it for day-to-day living? Or is there something else that's kind of happening? Anecdotal, but I am seeing it here in the Denver metro area. I live south of Denver, right? I live in the suburb, in Douglas County. And anecdotal, my neighbor, one of the houses around us, let's say, we bought at the same time. They put the house on the market. They have literally dropped their price by like $30,000 over the last week and a half, 2 weeks, to the point where the difference from where they bought the house and where they're trying to sell the house right now, it's only $7,000, right? Which is crazy. So you are starting to see cracks. You're seeing inventory move to the upside here, but when are we going to see those buyers getting off the sidelines? And that could happen as rates come down. But even if the Fed does cut, Jason, doesn't mean that the longer end of the curve is going to move lower. And in fact, every time we do cut, it moves higher. Unless you have QE or yield control, basically on the long end of the curve implemented by the Fed, I think that you have a situation where we remain elevated on longer duration until you see something crack. That's how I kind of look at it. I think the Fed's going to try to run this hot next year.
I do too. I mean, they keep talking about this 2% target. Like he gets on every time. He says we remain trying to hit our 2% target for inflation and so on. Like I'm sure they're going to move that to 3% next year. I'm sure that's just going to continue higher. I'm sure that the scenario that we're in right now leads, like all roads really lead to inflation. And that's what I do see at the moment. I can't see a scenario where we don't end up in some crazy amount of inflation. I see the fact that inflation continues to move higher and they continue to just overlook it. I see the fact that the Fed has become more political over time. And I see the fact that Powell's on his way out and doesn't seem to need to fight back like he used to. So I think it's just going to be a continuous situation where they're just going to continue to cut rates, continue to move this forward. And that's probably the scenario we're in, which is going to lead to a lot higher commodity price, a lot higher inflation in the United States at the moment. So let's move on. We've been talking about crude oil for a while, the economy and so on. So let's get into grains. I'm so excited to talk about this because Kevin and I, one of the first conversations I had with Kevin where I was like, damn, this dude knows his stuff. Like we were on some show. I think we were just talking stocks and random things. And I was always the commodity guy. So they asked me about a couple things in the commodities market, and Kevin hops in, after talking very eloquently about a bunch of different stocks, he hops on, starts talking about commodities, and knows it just about as well as anybody else on earth. So, talking about grains, we've been talking about this one for a while. And, the setup has been there fundamentally for a while, but it just never took off. And then just kind of bottomed out, went sideways. We had, cattle prices moved up higher, which, that's a feed. So if we're looking at soybean meal or corn, that's a feed for cattle most of the time. So that usually puts a lot of prices on it. Even if it isn't, it's just something people are going to look at. So now we're finally seeing the cattle prices move down. Now we're starting to see new 52-week highs in soybean futures. So, Kevin, what are we seeing here? Are we finally at the point? Can we finally get bullish on the grain space?
Yeah, I think if you're kind of looking at the trend right now, and this is not a recommendation, this is just the environment, right? I think if you're looking at it from a technical standpoint, we are trying to break out. I think you have some of the tailwinds still in your favor. You had excessive short interest within the soybean market. You had the trade talks, the anticipation of China buying grains. What was interesting is China actually did buy some grain and some soybeans actually about like 2 weeks ago. There was like chatter, let's call it the dark web, if you will, of the commodity market. No, but in the shadows, there were conversations that China was actually expected to, was actually purchasing some physical beans that actually did take place. It wasn't something significant. I think it was like, 3 cargoes worth, 800,000 metric tons, I believe.
Yep.
But it was a start. At least they bought something. And right now is when you need them to start. Because, I mean, usually in November is where we see a lot of export activity taking place because we're just harvesting right now. We're more than 50% through that harvest, probably even more than that, probably 60% at this point. And you are going to see, obviously, inventories build up. And where is this going to go? So soybeans itself, I think, has the enthusiasm of the market. You probably have some speculators buying into this space as well. You have some short covering taking place, and you are seeing a technical breakout to the upside. Now, we do have this gap. Let's just talk about, let's say, 11.40, so $11.40, where we could go and potentially test. You are potentially going to see a bullish cross here when it comes to the EMAs on the weekly chart. And then you have this downtrend as well as the 200-week moving average. I think if you hit 1,200 or $12 on beans, I think that would be considered a win for a lot of traders. And that could happen over the next couple of months or so. Could even actually happen a little bit more than that. Scott Besson did actually clarify. It seems like they are going to buy 12 million metric tons of American soybeans for the current season through January. See if that happens. We don't get the export inspection data right now because of the government shutdown. So you have to rely on third parties that's providing that data. And then Scott Besson said that they're going to buy 22.5 million tons for next year. Let's see if that actually happens. That's not a remarkable number by any stretch of the imagination either. So I want to be able to kind of put some context in here. China is buying, yes. Are they buying what they used to buy as far as the levels that they used to buy? Yeah, let's see. Maybe a little bit less. I would say it's about 90% of what we would like to see from China. We're going to have to still fill a gap here, but at least it's the right direction. Will they follow through is the big question mark. But I think over the next couple of weeks, if you start seeing that physical demand or that physical activity, those orders being purchased by China, I think that's going to be a tailwind for soybeans, at least for now. But you're not seeing this across the grain market. And in fact, you would think that wheat would catch a little bit more of a bid. Now it is off of the lows, but it is still in a downtrend, making lower lows, making lower highs. And wheat, the last commitment and traders report that we did receive, wheat was actually a very aggressive short. Like it was one of the biggest shorts that we've seen as far as positioning in a very long time. You would think that that would squeeze because of the soybean news. It didn't. Corn, same way. You would think that it would squeeze a tad bit more. Now corn is trying to consolidate, but you would think that we would see a little bit more of a squeeze there. Not happening. So across the grain complex, is this like the time right now you're going to see a massive cycle? Doesn't appear to be, but it does appear that we do have some optimism when it comes to the bean market, and we will have some headwinds though too. So be mindful, like once we get to January, February, we're going to get prospective planting data sets coming out. Does that look a very aggressive as far as the acreage? That would be bearish for beans. What's Brazil doing when it comes to planting right now? It seems like they're once again had a pretty decent clip of adding new production year over year. That's potentially bearish for beans as well. And then the wild card, dude, Argentina. What are we doing there? Because it's not just grains, right? We obviously now have a swap line with them. I think it's $20 billion and $40 billion in swap lines that we're giving to Argentina to stabilize their economy. Is there going to be some form of a deal where it's like, hey, pull back on your exports of beans, right? We're giving you $40 billion. We came to your aid, and you're right now, the setup doesn't look really great when it comes to Argentina. That's basically what I'm trying to say. We are giving them a swap line, and then we're going to allow them to undercut us on grain sales. Doesn't seem like that would be a smart move. And so I think the market's also kind of pricing in. Maybe there's a deal here where they're still going to have production, but maybe we tell them in the back channels, slow it down a bit and kind of force China to make these purchases from the United States. Because if China's not going to divest itself away from the South American market, they put way too much money there. And once again, their currency is a lot cheaper economically, it's easier to buy from South America. And that's nothing against our farmers. I love our farmers, right?
Yep.
I buy direct from farmers and ranchers all the time.
Mhm.
But they're at a disadvantage right now. And China might make some of these gestures near term to buy physicals from the US. But long term, is that really their vision? Probably not. So you probably get the hell out of Dodge after the next 2 years or 3 years if you see some positive buying data. And once you get closer and closer to the election again for the presidency, you probably see some pressure for soybeans unless the market dynamics really kind of change. So that's how I look at it. I mean, if you're looking at it right now, it looks like it's trying to break out. I'm looking at 1,200 or basically $12 for beans as your major area of resistance. I would consider that to be a win for a commodity that has been consolidating for a year and a half.
Yeah, so let's talk about China a little bit more. We have the scenario that's happening, and this is why everybody's interested in soybeans right now. People are actually like asking me questions about soybeans, which is wild. Everybody's interested in the grains all of a sudden. So if we're talking about China, and not to mention just globally, the BRICS nations, even some places in Europe like Poland and so on, they keep buying gold, and the reserves of gold continue to go higher and higher. I think we're at 30% of the reserves are in gold at the moment. And then the dollar, they keep selling more dollars. So the dollar reserves continue to move down. Do you think the idea here is like in the short term, like you just said, like in the short term, maybe China makes some gestures, maybe China buys from us a little bit, but long term, it doesn't make sense. And also like they continue to get out of dollars, get out of treasuries too, and they continue to buy more gold. Do you think they're trying to make a move off of, having to use the dollar at all at the moment? Do you think that's an area where we're kind of moving to seeing kind of a new global regime or a new global leader?
Yeah, I mean, it would be the smart move. Once again, I'm an American. I want everybody to utilize dollars, right? But we're going to
Yep.
talk about brass tacks here. In the Russia-Ukraine conflict, once the U.S., and this was under President Joe Biden, and it was something that what they did was a smart move. They did it at the wrong time. Like they should have pulled this situation. We put these sanctions on, and we basically like locked up or freed up or like locked up their dollar-denominated assets. This is a couple of years ago, right? And you saw the ruble like collapse. And why I say it was the right move at the wrong time is because they needed to do that at a time where Russia was actually like back against the wall, economy was already collapsing. And then you implement that type of strategy to basically like in Mortal Kombat, right? When it's like finish him, right? That would have been that final, but that's not what the US did. They pulled the ripcord on that policy way too early. And when they did that, every other country, no matter if they're an ally or an enemy, looked at it and said, oh man, like we probably need to diversify ourselves away because you don't know what's going to happen. No one does. Canada is like our number one ally. No one would ever fret at Canada right now, and in the past, right? A year ago, Canada, not even on the map. We talk about them as friends, allies, whatever. And now it's kind of like contentious. Who would have thought? Right. And so things are going to change. And I think you are seeing countries kind of diversify themselves away, looking at hard assets like gold for that diversification, looking at these treaties and pacts and doing their own swap lines also. And that may actually put a little bit of pressure on the dollar over the long term. Is the dollar denominated trade going to change or shift overnight? No. It's going to be a very long time for that to structurally change here. But I think you are seeing the adjustments being made slowly. China is not selling their treasuries. They're just not buying and backfilling their portfolio, right?
Yep.
So those are kind of two different things. If you saw China selling their treasuries, it would be a completely different matter, right? Like that would be kind of like their nuke on the financial sector to kind of signal like we're done. They're just not really backfilling. Right.
Yeah.
They're kind of like,
Well, I mean, but they did forever, and now they're not. Now I mean that's been going on for a while, so it is interesting. So we'll see where that ends up.
Yeah,
Our
but
next
I
one.
think you are seeing a slow deterioration of dollar utilization, and a lot of these countries as well have been able to do and commit and complete trades with their own currencies as well, and they seem to be fine with that. India is a really good example of that, right? Where they can buy Russian oil with the ruble and not have to really worry about the dollar. For whatever reason, they're going to take that in, and they're cool with it. So yeah, I think that's going to happen over time, but I don't think that's a 2026 headline story yet.
No, I think that makes sense. So let's hop into speaking about China. You know, we got copper here, Dr. Copper. Let's see what it's looking like. You know, we're over 5. What's the level for you that you're looking at this thing and going like it's really taken off, or are you just thinking like it's still kind of range bound at the moment?
Right at this level here. This is actually very key because what we have seen is obviously some bullish activity, some bullish narratives when it comes to the fundamentals right now, and now you're just seeing a battle taking place around this $5.25-ish area. And we're going to see how this is going to resolve itself. Do we actually fail lower, or does this go higher? I think if you break the 625-ish area, that's probably when you see a massive ramp. But it would not be a surprise for me to see copper trading at $5.75, just given the structural nature of the shortages that we are seeing right now. And if we do see any type of relaxation of tariffs against China, do we start seeing economic activity really spark up there, right? Their industrial production numbers starting to hit 7.5%, 8%, 9% or so. Do we start seeing those smelters starting to come back online a little bit more aggressively? We've seen them back off of those smelting activity a little bit. And this is China, by the way. Do we see that also ramping up? And then also, you know, people don't really talk about this. Do you see the recycled business actually ramping up as well? Completely in the background, no one's talking about that, but that could be the case. This is not copper related, but aluminum. What's actually very interesting, there's a lobbying group that's in Washington right now that's trying to block the exportation of aluminum and aluminum cans, recycled aluminum cans, outside of North America, because there's a structural shortage with aluminum right now. There's a plant that got impacted like a couple of weeks, about a month and a half ago. It's obviously impacting Ford. I think Ford had to take a $1.6 billion write down or something like that because of this lack of aluminum. And you have, and I kind of go to, and I know this isn't copper related, but just think about this. Aluminum cans, dude. Not exporting aluminum cans outside of North America is wild work when you're talking about supply and how much of an impact that can have. Now, when I read that headline, I laughed my ass off because it's like aluminum cans. Like, we are literally looking for aluminum cans to be able to build out planes and build out cars. So there's a structural shortage when you're looking at the metal market as a whole. That's a story that has not been talked about a lot, but it should be taken seriously because it sounds like a clown show, because it is. But if there's another reason, there has to be a reason why they're actually advocating for this, because we do have structural shortages. And I think copper could be in that same light, where the recycled market could actually boom here fairly aggressively, and that could push prices up a little bit more. And so I'm looking at $6 to the upside as a resistance-ish area from a technical standpoint. Any breakdown between below $4 gets a little concerning. But with the mines, and it seems like it's everywhere, Indonesia, places in South America, every mine right now is having an impact. And when we talk about these copper mines, it's not just copper, right? Copper mine also produces silver, also produces gold, also produces, you name it, rare earth metals.
Zinc,
so when these things go down, when these things, iron ore, right? So when these things go down, it impacts all of it. It's not just copper. And so that, I think, once again, is a little bit of a tailwind to the upside for a lot of these metals over time. And it's not even based on demand. We're not even talking about AI and data center build out. We're not even talking about the water build out for AI, which is literally the biggest story that we should be talking about daily. It's not the fact that AI and these data centers got to be built out and it's all this copper draw and all that stuff. It's water. We don't have that infrastructure. And a lot of these metals are going to be a part of that infrastructure build. So you can make the case that next year, 2026, you could see a pretty decent ramp up, because not only just demand, but also supply constraints within the metal space. I still think you look at the metals first outside of the miners, but some people like the miners. You know my feelings about that. We won't go back and forth on that one today.
Yeah, I was gonna. This guy brought up a question. Ethan brought up a question. Great question, but I was gonna say, Kevin. I know Kevin's answer already. It's gonna be buy the commodity, and mine's a little different. I do trade the sectors. So I have 2 different funds I run. One is more longer term, one is shorter term. Shorter term is more futures, and then longer term, I use a lot of ETFs. So something like COPEX or GDX right now. And it's like, it just kind of goes back to, do I have a crystal ball? And the answer is no, I do not. But for me, how I'm positioned, I can say that I do own GDX, GDXJ, and some of the gold mining names. And also I do own COPEX at the moment, and some of the copper mining names. So I do think like they're both set up well. If we look at like GDX, like it's run a lot. Do I think it's going to make another 100% run? I'd be surprised. Could copper miners do it? Maybe, and that's a possibility. They could go up a lot more. They've already made a big move. They're finally getting above those old, I think they were 2011 highs. XME's getting above its 2008 highs. We could see this thing really take off. But remember, these are very volatile stocks. Like, you could get an earnings day, or you could get a mine shutdown. And, one of those stocks could go down 20, 30, 40% very quickly. The smaller names could go down even more. This is the reason why when I do recommend things like this, I do say, like, use the ETFs if you really don't know the space really well. The ETFs are going to at least hedge you a little bit from things like that happening. Yes, they're going to get top heavy at times and so on, just like anything else, but you're going to get exposure to the sector in a broad way, rather than just being exposed to one or two names and then you just get hit for like a 50% move on an earnings day or something. So I'd say own the whole sector, but one or the other, can't really pick. But I do say copper miners might have a little bit more upside than gold miners at the moment, if we are running through the cycle the way I think it is. However, no crystal ball here. So let's move on to the next. Go ahead, Kevin.
Just real quick, man. So we did a show about a month ago. I think that was the last time. And we talked about three names: FCX, right? The three main copper producers, domestic copper producers here in the United States that are publicly traded, right? Rio Tinto, Freeport-McMoRan, Southern Copper. That was a month ago. Check out what Rio Tinto is doing right now. A month ago, what we were sitting, Rio Tinto up 10% in a month, which is a name that usually doesn't run like that, right? Southern
Big
Copper,
name.
if you go back and look at Southern Copper, SCCO, up 28% in a month, right? Last 4 weeks, 5 weeks or so, right? Freeport got hit, but is trying, right? It's like the little engine that could. It's the one that always has the bad news, but buyers, for whatever reason, still want to step into that name. And so you're starting to see that one kind of it's failing a little bit, but maybe it's consolidating over the last couple of weeks, right? It's been trading at the $69, $70-ish area. Now, not a great candle last week if you're looking at the weekly, but it's trying. If you're seeing one name get hit in the US space, one of the other names too is usually getting the tailwind. And a lot of this tailwind has been Southern Copper, right? As soon as the news came from FCX around their production issues, Southern Copper, like, phew. Now it's a very thinly traded name, and you're looking at the options here. And I believe they actually have earnings, this week or next week? So we'll be on the radar for that. Did they already have earnings? Let's see. I think they actually reported already. Yep, they did. $1.16 or $1.35. Shooting for $1.16, decent little reaction post earnings. So the copper players are still kind of in control, and I still think that if you have these production issues for next year, like a lot of these companies are saying, I would not be surprised if you see the U.S. government actually putting money to work on the copper miners. It would not surprise me. They're doing it in lithium, right? Right. That's why the lithium players are moving higher. They're doing it, or going to be doing it, and the uranium companies, which is why you're seeing a sustained bid there.
Yeah, look at the candle kind of CCJ, you guys. Like, look at CCJ, and copper is needed for all of these things. All of these things we need copper for. So I think you're absolutely right. And so the domestic players are probably going to be very interesting. I do own some international ones. BVN still looks good. That's one of them I really like. But once again, it's make sure you know what you're trading and continue to own the things that you know. So next one, consumer staples. So, I'll have to get off of here in a few minutes, probably like 10 more minutes, we'll get off. So looking at consumer staples, we're seeing that breakdown. Man, consumer staples are the ones that everybody thinks are going to be the risk off indicator, and most of the time they are. However, the one thing that's also interesting is you usually don't see them breaking down like this in a bull market. Usually they're the things in a bull market that are just underperforming. This is a breakdown. We're getting right back to a moving average. Maybe it'll bounce here, maybe not, but so far it looks like crap. I don't own any of these things. I do not own the sector. I'm still in mainly reflationary trades and inflationary trades at the moment. Some technology at the moment. So Kevin, what are we looking at here?
Yeah, and I'll be very quick with this one because I think the next one is actually going to be a banger for people to kind of talk about. But if you're looking at the staples, it's coming down. This is a 3-year weekly chart coming down, hitting that 200-week moving average. So yes, we are seeing some weakness when it comes to the staples. The reason why I'm bringing this one up, hitting a key area of support. Let's see if this holds, or we do see some type of major flush occurring here. SNAP benefits has been like the headline over the last week, right? So the U.S. spends around $100 billion for SNAP benefits or food assistance programs. We know that that's in limbo at this point in time. And the reason why I have this chart up, Walmart gets around 25% of all of those SNAP benefits. So every year Walmart receives around $25 billion because of SNAP benefits. And you're talking about the shutdown and the potential that they're not going to see those inflows in revenue. It's talking about $500 million a week of impact that we could see for Walmart, which could actually put some more pressure down on the consumer staples. And if you see any type of reversal of that kind of commentary over the next week, you might actually see a bid going into Walmart, going into Costco. Not Costco, not so much. And it's nothing against it, but usually those that have those benefits are not usually going and spending the membership on Costco. They're usually going to either Dollar General, Dollar Tree, Walmart for that matter, or even Target, right? So consumer staples getting hit. I think there's also, once again, some risk here for top line growth because of this impact for the government shutdown, but a key area of support. So let's see how this actually reacts. But for Don, talk about this next chart, man. I think.
This
is interesting.
We'll make time for the next one, but yeah,
Okay.
just wanted to add this. Just so people know, people keep asking for Qs and SPY charts. It's like, man, anybody can pull that up. There's probably 1 billion of those online today. That's the most normal chart, the most shared charts. What we're doing here is we're kind of going through sectors and kind of getting an understanding of what's going on with the economy, what's going on in certain countries, what's going on with the macro environment. So we're not going to pull up the SPY chart at the moment. I mean, if it's in an uptrend, they're all in uptrend. So that's as simple as I can put it. But looking at consumer staples, like this is your Walmart. People aren't why we call this a risk off sector is because when there's a bad environment, let's say we're in a COVID scenario, people are going to be buying more. People still need to buy toilet paper, people still need to buy beer, cigarettes. They still go to the store and do all these things. So you'll see these consumer stocks are still catching a bid during those times, or at least outperforming the market. And then when there's periods of time where there's a lot of risk on, technology is going up like crazy, consumer staples usually lag. So this is why these charts are very important to go through. And to Wavy's point, I don't, for me, looking at things that are just breaking down, they're not things I'm going to get super excited about, buying things in that are falling. But once again, there's a reason why we put this up here is because one, this is going to tell us, like, are we still in a bull market that's very risk on? Is it risk off? These are all the things we need to really understand to continue to make money. And yes, like good point, Ag, let them dance. Like sometimes, yeah, you got to let them dance, but this one, I'm not letting this one dance too long.
And these are companies that have been getting hit from tariff. I mean, like if we're wondering where the tariff impact is actually happening in the economy, each and every one of these companies, for the most part, has some exposure. If you're looking at the XLP holdings, right? So Walmart, Costco, Procter & Gamble, Coca-Cola, Philip Morris, throw that one to the side, right? Like that's Pepsi, Mondelez, which had horrible earnings. All right, but a lot of these companies are getting impacted by tariffs themselves. Now, Mondelez is also getting hit by the cocoa trade. So like there's this probably poor management when it comes to hedging for that company, which is why you're probably seeing it move to the downside here. But a lot of these companies, obviously, tariff exposure. Now, we start seeing these tariffs coming lower, right? 10% tariffs instead of 20% for fentanyl. Maybe we don't even have that 10% anymore. Maybe you start seeing that come down a little bit. A lot of these companies have already forecasted the impact of tariffs on their business. So could you actually see, I'm not saying next week, but could you see over the next 6 months, hey, trade is getting a little bit more favorable. Tariffs are getting cut. Better guidance moving forward. I mean, staples is one of the. There's only 3 sectors that are looking for year-over-year earnings contractions. I'm going to try to do this off my head here. Energy this week. Energy is looking for year-over-year decline when it comes to EPS as well as revenue growth. That's not happening. Very low bar. A lot of these energy companies did really well this quarter, and margins are holding up. Somebody posted about the refiners. Margins are holding up. Consumer staples, once again, that very low bar for them for this earnings season, and I believe it's healthcare, right? Those are the 3. All of them, for the most part, a little bit defensive. But this is a sector that's hitting a key area of support here. If you want to bottom fish and you want to take a shot, I wouldn't be mad at you on that, right? But it does look like it's trying to roll over. You just got to be mindful of that. And the headwinds have been fairly great. So any conversations around tariff impact, tariffs moving lower could be a benefit for the sector. And this is the last thing too. Tariffs move lower, the prices of their products, they're not going to move them down. So it should be like, you should actually see margin expansion for a lot of these companies. They're not going to move the prices down for the consumer because tariffs are lower. This is not how it works, right? So there could be a narrative for the consumer staples over the next 6 months or so, but this chart kind of looks like it wants to either roll over, or this is one of the really big bull flag patterns.
Make or break point.
Right, exactly.
Yeah. And it could be great. It could be a make or break point. 200 weekly moving averages. We see a lot of bounces around those zones so it's something to keep on everybody's radar. So next chart, let's talk about gold. So much going on with gold, finally coming off.
Oh, my bad.
Did you have a different one in mind?
I was thinking lean or live cattle.
Oh,
you could do gold though. It's up to you.
We'll do both. We'll talk about gold for just 5 seconds. Just basically, coming back off, still in an uptrend, still, basically holding up very well. I don't, to me right now, it's like I'm not really too concerned with it. I know everybody's like, oh my gosh, gold fell. It's like, yes, things go up, they go down. Markets are volatile. Commodity markets are the most volatile. This makes perfect sense that this thing would pull back. I did not think this thing was just going to go up in a straight line forever. But next one, cattle. Let's hop into.
Actually, the gold one's so funny. We talked about this a month ago. I want people to go back and listen to that video because one, I think the insight was really great. And we kind of talked about a lot of the nuances within the gold and metal space just in general. And I don't know if you remember this, Jason, but one of the things I said, it's not usually the even numbers or the milestone numbers, 2,000, 3,000, 4,000. It's usually 4,400 or 400, whatever your main handle is, for whatever reason. And if you look on this chart, what was the top? 4,398.
So you got it wrong, Kevin, is what you're saying.
Well, 4,398 was the front month print.
I'm just kidding,
right? Yeah. So the thing is that look, it can consolidate, it can come back. Look at that 200-day or the 20-day moving average, 20-week moving average. I'm sorry, 3,620. It comes back down there. That has been the reset cycle for gold. So it could continue to move a little bit lower here. And it looks like it kind of like wants to roll over. Volume actually looked pretty decent on Thursday and Friday though. Maybe you're getting a little bit of a retracement bounce, but you want to flush out the retailers. I'm sorry, I'm gonna have to say this, dude. You want to flush out that speculation that we saw. It was just not healthy. Yeah.
Well, we saw also, if you look overseas, we started to see lines out the door at gold dealers and so on. It's like that's too much. And when that starts happening to a big degree, we didn't see that quite in the United States, but we're seeing that in different areas. And so, like, as long as we're seeing that, like, that's not a good sign. So we need some of those to get out of this market to continue that uptrend if it's going to continue. But yeah, I like this chart. I think, number one, if you're looking at a market, you're long something. Let's say you want to catch a trend. I always tell people this all the time because people are like, man, you're a trend trader. How do you catch these trends? It's like, yeah, like something like, Bitcoin. How do you catch Bitcoin from $1,000 to $20,000 in 2017? Well, number one, you're never going to buy it perfectly at the bottom. You're going to probably buy it around $2,000. It's going to hit 20 and then it's going to pull back. And then it's also going to, shake you out around 17 or something like that. So you're never going to catch it perfectly. And then the second thing is they're volatile. Every single trade is going to be volatile. You're never going to go up in a straight up and down line. And there's going to be plenty of points where you're going to want to get out of these trades. For example, with gold, you go back to, look at the early beginning of this chart with the breakout happened in 2024. If you're long it in 2024, yeah, it sounds great. You got long around 2,000, 2,100. Awesome. But how do you hold on to that trade? You know, there's plenty of times where people would go, hey, gold's over. Hey, look at this consolidation that happened even this year. I think that was from April all the way till, you know, just recently that just broke out again. Was that September or August? So, you know, we had a long consolidation there, and there's going to be lots of times of pullbacks and volatility and so on. You just have to really understand, like, hey, when do I get out? When do I get in? I think Kevin shows this beautifully here, which is you could just use something as simple as this 20-week moving average. Below it, you know, you want to close your position. Above it, you want to hang on to that position. You could use something like that. I don't use that type of model, but just saying, this has held that trend and it's shown up pretty beautifully. And you're not even getting closes below the 20. Actually, that's something that also you want to pay attention to here. If you look at this, like this red candle, it didn't close below it. Obviously, this is above it. These green, the red didn't close below it. These greens ended the day closing above it. Same with here, we're closing above it. So I think this is a good one to continue to look at. I like this level of 3,600, 3,700 being a area of support. So if you have nothing else to add, Kevin, I'll jump to the next one.
Yeah, no, I think you hit the nail on the head there.
Nice. All right, so live cattle here, and we're gonna end with this one, which is really fascinating. So I don't know where this was one of the craziest trends I've ever seen in, I don't know, all markets, most commodity markets. Just I think, what did it have at 1.13 months up in a row or something crazy? Like it just continued to be in this wild trend for many, you know, a couple years now, basically since 2020, really. So this thing's been in a nice trend. Yes, it's had some consolidation as you see here, but then we just continue to move up higher. And now today we're kind of pulling off a bit. We're seeing the moves in grains start to turn up. What are we thinking here, Kevin? Do you think that this is going to continue to move lower? What do you think about the cattle markets in general? I want to hear your opinion.
Yeah, the reason why we are seeing the cattle markets move a little bit lower here is because the Trump administration is open, and it sounds like they're trying to make a deal with Argentina as well as, I believe, Brazil to import cattle in order to try to help beef prices. On the surface, for the uninitiated, you would say, oh, okay, that sounds like a great idea. But for those that actually kind of follow this market, it won't do a dent when it comes to beef prices at the table. A lot of the beef price surge that you are seeing is actually producer or processor driven. It's not those that are actually raising the cattle on their ranch. Right. And actually, if you kind of look at it, the price is still very elevated. Feed prices, no one has water in some respects in certain areas of pockets of the market. You can look at Texas, you can even look at here in Colorado. But the processing market itself is very concentrated. There's only four companies that actually process, four major companies that are actually being processed. And one of them is actually publicly traded, JBS. And so you are seeing maybe some of this rhetoric of let's bring more cattle in, we bring more feeder cattle, bring in more live cattle, producers have more supply, prices should go a little bit lower. There's a risk there. One, if you're kind of a smaller business, you may not want to bring the cattle from Argentina and from Brazil. They do have like foot and mouth disease, and you bring one that has a disease that could actually impact the whole herd. So that's a risk there, which is why we actually kind of stopped importing beef from Argentina. Nothing against Argentina, but at the end of the day, the quality of beef or quality of cattle, not beef, because beef and cattle are two different things, right? Quality of cattle hasn't been that great. And there's a risk that it could actually taint U.S. Supply. But a lot of this is being driven by the producers themselves, or the processors, I'm sorry. So you are seeing a breakdown here, a very violent week when it comes to live cattle. Let's see if it actually holds up. If we continue to hear some of this rhetoric coming from the White House, I mean, I would have expected President Trump to take a shot at cattle ranchers, like a tweet or a post about that. Like that was not on my, and there's a lot of things not on my bingo card this year, but that one was completely by the wayside. But let's see if this is going to open up. Now, you did see a bid on Friday, I believe it was on Friday, because we are not going to open up Mexico's import or like ramp up Mexico or bring in cattle from Mexico. Like right now we have a blockade on that. There was also a thought that we could do that as well. So all in all, just to say, could it break down a little bit lower? It's been a really nice trend, but we continue to get a lot of this bearish commentary of trying to import a lot of these, live cattle, or even importing or ramping up the importation of beef products alone. That could actually bring prices to the downside. That is not going to correct the long-term trend when it comes to the supply of cattle in the market, right? As prices go lower, ranchers are just going to hold off because you can't really ramp up because a lot of this stuff is structural in nature. You just can't make water out of nowhere and put it on the land. It gets really, really expensive. So keep your eye on this one. If we do see it crack, though, I mean, this could be a very big component when it comes to CPI. But I think if you're looking at the longer term impacts of the physical markets, it's not going to, in fact, it probably would make the situation a lot more worse. And actually, cattle prices could move higher if you start this importation of cattle especially from South America. It sounds crazy to say it that way. It'll have a near-term impact on prices moving lower, but I think long-term it'll still move prices higher because there's a lot of disease risk when it comes to that those areas. So that was it.
Nice. No, perfect. So thank you guys so much for joining us. Love to go through all these grains and cattle charts with Kevin, because to me it's like this is, we might be talking about commodities here, but we're really talking about the macro environment and what's going on with people in their own homes. If you go to the store and you're a person who eats meat and you're buying steak, like that's a very expensive investment at the moment. You're looking like if you're not like I think Kevin does the same thing I do. We buy from ranchers. We end up getting half cows or full cows or whatever, putting it in a freezer. But if you're just going to the supermarket, you're basically buying one-offs, and it's like an 8-ounce grass-fed steak is like $12 or $13 a steak at the moment. I mean that's crazy. And then you got to feed your family on that. I mean, it's a lot of people are just going to bypass that at the moment. And some people are still buying it. So it is what it is. But this is all. Go ahead.
Somebody posted, it was an article.
I kind of responded on your page.
Yep. That was so wild. Oh, people are buying like whole cattle because they're feeling the pain. Do you understand that like even a half a cow is easily over $2,000, easily over $2,000 right now, right? 2,400 probably, give or take. Depending on what type of beef you're getting as well, right? A lot of people that are buying cattle are trying to buy grass-fed. I don't know why you would buy straight up processed or the cow that's eating grain and buy that, because you could just go to the market and buy that. But I just found that like crazy. Like, I understand, right? It's a way for you to save money, but like if you're looking at a consumer that's stretched right now, a lot of consumers can't just come up with like $2,000, $3,000 and buy a whole cow.
Exactly. That's the point. Most people don't have that type of cash laying around, generally. So like, I mean, if you did, like most people would be planning for the future, doing things like that. Like you buy half a cow instead of, you're going to spend maybe, let's say grass-fed, $5,000, $6,000, maybe even $10,000 trying to buy it piece by piece, but buying a half a cow will save you that much money. Understanding that you can pay things in advance, it might save you some money. Whatever you're doing, like a bunch of ways to save money, but people don't have that type of cash at the moment to do so. So the last thing they're going to do is go buy like a half a cow and think, because generally here's a one thing to think about. People just aren't very long-term in their thinking. People aren't long-term in investments. People aren't long-term in their thinking. Most people think pretty short-term. So, thinking that that's happening and that's this huge thing. No, it started, back in 2020. It was, hey, a lot of people want to be healthier. Hey, a lot of people buying deep freezers kind of became a thing in the United States, and we got all interested. So it's mainly like people who are more affluent doing things like that. Even though you should be doing that, even when you're not as affluent, because you'll make more money or save more money in the long run.
Yeah, no, and I would say like if you are ever interested, ask your buddies. Like it's nothing for 4 families to go in and get a quarter cow each, right? And you do save money. Now, what you save money in a sense that, I mean, it also depends on the processor, but you save money per pound in some respects. But also it's the quality of beef too. So like people that usually like to do this is not only just like trying to save money when it comes to the per pound, but it's also like, hey, I like I want to get something that's grass fed or something that's raised in my community or, raised in my area, and not cattle that's kind of squeezed in together and just, things that they were fed is not the best. Let's say that, right?
Yeah.
Some of the stuff is like to make the cows bloated and expanded. I mean, chickens, we do the same thing, right? The feed that the chickens eat, they actually cannot live off of that feed. They will literally deteriorate in-house if they're not slaughtered in the amount of time. We're going off a complete tangent. My bad, dude. But like,
No,
there's
that's
still
good because
opportunities that are available. You just have to ask your friends. You don't have to just buy. And there's a lot of companies now you can buy, and it sounds crazy, but you have quarter cows. You can buy an eighth of a cow. Some of them have those projects that are available too. You could also do, there's a company that we have out here that you can buy the beef per month. So you do you could do a quarter cow, but they split up that quarter cow in payments, right? And so they ship it to you just like an Instacart or whatever. So you don't have to come out of pocket $800, $900, even $1,100, depending on the quarter cow you get. Right. And so you could break those payments up to $200, $300, and they'll send it to you that way. And sometimes you just got to talk to your providers. A lot of them are willing to work with you because bringing them to market also costs them money. And so they make better margins selling directly to you than actually kind of bringing it through the whole system. So, and then look at community supported agricultural programs. I don't know what's going on with the government, but if you look at community supported agricultural programs, a lot of communities have them where you have like local farmers and stuff like that, and even like hobby farmers, hobby, planters and those that have gardens and things of that nature. You could buy bushels from them for the cheap. And a lot of times it's once again a lot more healthy than what you're getting at the store. So
no, I love it. So, we could talk about that stuff all the time, but we kind of do drop those nuggets from time to time. And so hope some people pick it up. I know there's people from, I'll get a call sometimes, like from people like, and just have a conversation with someone from like India or someone from another area. And they're like, man, you guys eat so much meat in the United States. It's crazy. It's like, it's not the point of like we have a freezer so we're eating this like 7 times a day or something. Like it's just the fact that we have a freezer and this will last like a year or 2 years and feed a whole family, and it makes us a lot happier. It saves us some money. So hopefully you guys had a good show. We really enjoyed having you guys. Hopefully you guys learned something about eating healthier today. But most importantly, I hope you guys learned a lot about the markets. We covered a lot of stuff from oil, the Fed, gold. We talked about bonds. We talked about everything, just about everything in the market. So, and including cows. So we talked about that as well. So, all right, guys, take it easy. Kevin, as always, thanks for joining me. And we'll be on, I'll be on this week. The Gold Rush show is at 2 p.m. Eastern time on Thursdays. And then Fridays, I have Kashop with me for the Holy Macro show. That's at 10 a.m. Eastern time as well. See you guys later.